All right, so that's about the markets. But moving on, with every day the Iran conflict and the closure of the Strait of Hormuz that continues, the global impacts and economic fallout increase. The fate of the world economy now depends on whether and when a real ceasefire emerges. The stalemate holds or the conflict widens. A World Bank and International Monetary Fund research shows that 15% of global oil supply is still blocked at the Strait of Hormuz that runs up to 15.8 million barrels per day. That's roughly about 62,000 barrels per day of jet fuel is also blocked at the strait. Global GDP losses currently stand at $590 billion, or about 0.5% of world GDP, if the conflict ends now. In the most likely scenario, based on the current back and forth between the US and Iran, is a phantom ceasefire. And under this scenario, the global GDP loss is estimated at $3.57 trillion if the war continues for another month. The scarcity and supply crisis is reflected in the difference between the physical oil price of over $140 per barrel and benchmark Brent futures trading at around $110 a barrel. The over $30 premium confirms the physical market scarcity. The world's most critical energy choke point has stranded approximately 75% of Gulf countries and Iraq energy exports. And that has triggered the largest supply disruption since the 1973 Arab oil embargo. And as a result, Gulf producers face revenue collapse. They are unable to export. On the other hand, economies reliant on Gulf energy face severe energy import cost shocks with no domestic alternatives. Increasing energy and fertilizer costs directly translate to rising consumer prices worldwide. Rising prices alongside slowing growth is the central macroeconomic risk right now. According to the IMF, the stagflation risk is no more a prediction but a stark reality today.